When someone promises me 18% return, I would be extremely hesitant of going ahead with it without understanding who's guaranteeing me the money, how are they guaranteeing me the money, and what happens if this institution doesn't exist, who's protecting me to make sure I get back this money, and who's done the due diligence, who's looked into this company's books to say what's the likelihood of this company still existing, regardless of who they are. When someone guarantees something, so for example, let's say Nestle is saying we give guaranteed returns of 6%. What that essentially means is if I give money, then Nestle owes me that guaranteed return. I don't have to worry about anything else because at the end of the day, they will take the risk and they will give it back to me. So then the question becomes, okay, it's guaranteed by them unless they are unable to pay me. So it's guaranteed, except if the entity that's guaranteeing it to me is unable to pay me that money. Let's say HSBC tells me we can guarantee you a 5% return. And then let's say there's a Turkish confectionery company, Ülker, who can guarantee me that 5% return. Now, HSBC is international. Ülker, most of their revenues are in Turkish lira. If I had to choose who to give my money to, I would naturally feel more comfortable giving my money to HSBC. And therefore, if both HSBC and Ülker both gave 5%, me and mostly everyone will choose to give money to HSBC, and HSBC would have funded their operations or whatever they're doing with the money and guaranteeing me the 5, they will take it and they will operate. And Ülker, still looking for money, will not get any money. So Ülker will have to come in and say, hey guys, we're going to give 7% return or 8% return. They're going to have to give a higher return to attract my capital. So essentially, the way the market works, there is so much money out there. We're talking about trillions of dollars looking for a home, looking for opportunities, so that if someone is guaranteeing you a return of X percentage, why are they giving 18% when they can go and raise money and HSBC is giving 5%? Right? So what is the risk there that I'm taking? What we call guaranteed opportunities is fixed income or bonds or notes. If we look at the market today, we look at treasuries, which are US government. So essentially, if I'm giving money in dollars, US Treasury is the safest thing because they control US dollars. They have ability to print or to run deficits, etc. The US Treasury today on 10 years is approximately 5% return. And then you have a name like HSBC, which is somewhere plus minus 6%, maybe a bit less than 6 and more than 6. And then you have companies like Nestle at 6% return. Then you have higher risk items paying 7 or 8%. So we go into these higher risk elements paying 7 to 8% or 9% or 10%. What you realize is even risky institutions are able to get billions of dollars from investors by guaranteeing 10% return. So why would they be promising 18? When I deal with individuals who have such a proposal, the first thing we look into is who's regulating the entity, who is the entity, and then what's the logic of how this investment is working. Investment has to be logical. Wherever you're putting your money in, it has to be logical of, oh, that makes sense. At the end of the day, return has a very direct correlation with risk. There's two types of risk. There's the risk where, yeah, I get back my money every single day and there's no volatility. I know exactly what I'm supposed to get. And then suddenly everything fails. That's one type of risk. And there's another type of risk, which is volatility risk, which is similar to real estate. In real estate, the price of my property that I buy every day is different, right? If I sell my property today, it will look different than tomorrow. And that's volatility. And same thing with equity markets or any other market, usually there's volatility. So the first question I have to ask is, okay, I'm being rewarded by 10%. From what risk am I taking? Work with a good financial advisor to understand those risks. And then after you understand those risks, say, those are risks I'm willing to take to generate that return. And that way you went into the investment in a right frame of mind.